put option for 60 days, because 60 days anything can happen. Volatility, similarly, the more the volatile or variability of the currency is more, then the premium will be more, because anything can happen. Uncertainty is there. When there is uncertainty, whether the value will go up or go down, nobody knows. It means you have to pay higher premium. Simple, right? The only thing is that the buyer of the put, he will enter into a contract that he has option to sell at a specific price. And why he sell? Because he knows that in future price will go down, right? So in order to exercise this option, he need to pay the premium. When he pay the premium, the seller of the put option, he will be receiving the premium. But if we categorize in buyer and seller, so seller input option is called buyer of the put option. Buyer is called the seller of the put option, right? So this is a little bit confusing, but more technical. Everybody understand that? Florian, Fabian, Lota, Marilyn, Ping Ping, Crystal, Janlap, Kathleen, Nimesh, understand?
Yes.
Yes, sir.
Good. Let's move forward. So similarly, we can hedge and we can speculate. So how we can hedge? We can hedge with different ways in which we expect that any condition, any situation in which your business dealings are like that and you're worried about that price will go down, you can use put option, right? Here we go. So assume Duluth Corporation has exported products to Canada and invoice the products in Canadian. So the American firm, they exported the goods in Canada and accepted that they will be receiving in Canadian dollar. So their biggest risk is that when they receive the Canadian dollar, the value of the Canadian dollar may go down, right? So it means they have at the expiration, they have the Canadian dollar, and they worried that when they sell the Canadian dollar, they convert into dollar, the value of the Canadian dollar will go down. So in that case, they should enter into buy put option, right? Buy put option, because they would be receiving, right? So they would be in ownership of the Canadian dollar, and in order to convert Canadian dollar into dollar, they would be selling Canadian dollar. So their biggest risk is Canadian dollar price may go down, right? Here we go. So Duluth is concerned that the Canadian dollar it is receiving will depreciate over time. So to insulate or to protect itself against a possible depreciation, Duluth purchases Canadian dollar put option, right? So seller of Canadian dollar is basically buying the put option, right? Seller of Canadian dollar, because they would be having Canadian dollar and they would be selling the Canadian dollar. They would be buying the put option and they would be paying put premium. So in a sense, so which entitle it to sell Canadian dollar at specific strike price. In a sense, Duluth locks in the minimum rate at which it can exchange the Canadian dollar for US dollar over specific period of time. If the Canadian dollar appreciate over time, what if the Canadian dollar appreciate over time? So the seller of the Duluth, the seller of the Canadian dollar, they will cancel the option contract and they will sell their Canadian dollar in the market. So Duluth can let the put option expire and sell the Canadian dollar it received at the market or prevailing spot rate. That's it. Understand? It is just a fancy jargons to put option, seller of the put option, buyer of the put option, premium. Otherwise, if you convert that into very plain and simple language, it is very logical, business routine. That's it. If I'm receiving something, I lock in the rate, I minimize my risk, I sell it at specific price. That's it. So I am worry free about what I will receive. So I can plan better. Simple. That's it. So currency put options, one step advance. That is, corporation in foreign currencies can use currency put options in some cases to cover positions. For example, some put options are deep out of money. Deep out of money means put option, when put option is out of money, when spot market greater than exercise price.
Wait, keep out of the money. It's
Yeah, I'm explaining that. Out of the money means when spot price is greater than strike price. Deep out of the money is that when the chances are that this condition will hold for a longer period of time. So when put option is out of money for sure for a longer period of time, or you can say that the strike price is 0.54 dollar over Australian dollar, but spot price is 0.68 dollar over Australian dollar. In this case, you see the difference here. Difference is 0.14, which means it's huge. Difference is huge. When the difference is huge, we call this deep out of money, right? And this difference cannot, from past history, you find out cannot be filled in 30 days. We saw that in 30 days, no way that the market will drop to 0.54. Right now, the market is 0.68. In 30 days, no way it can be dropped to the past history and all the stuff. It is more stable. And you find out that it can never be 0.54 in 30 days. Maybe in 60 days, maybe in 90 days, anything can happen, but 30 days it cannot be. So in this situation, is called deep out of money, right? If some position options are deep out of money, so it means how you can earn profit, how you can speculate. So you just earn premium. That's it. You sell the put option because you know that market can never be in against your favor and nobody is going to sell you. So you just receive the premium and earn a little bit money, and that's it. Because you know everybody will let the put option expire. Nobody care about that. So why I left behind? I should enter into seller of the put option. I will receive the premium. That's it. Right? So some put options are deep out of money, meaning that the prevailing exchange rate is high above the exercise price. These options are cheaper as they are unlikely to be exercised. Their price is too low. So in this case, you can earn a minimum profit by selling the put option. Of course, very small. Premium would be very small because we know that it has a negative relationship with put option. Other put options have an exercise price that is currently above the prevailing exchange rate and are therefore more likely to be exercised. Consequently, these options are more expensive, like I told you. If exercise price is greater than the spot price, chances are that they will be exercised. When they will be exercised, their premium will be higher. It means they are costly as well. The seller, they are not stupid. They are also analysts. They are also selling the put options. They are also dealing with the currency. They are not stupid. So they increase their rates, right? So that's why that they will these kind of options will become more expensive. We call this deep in the money. So similarly, you can speculate with future forward. You can speculate with forward. You can also speculate with put option as well. So you are not exporter and you are not importer. So you want to earn profit, and you, according to your analysis, your programming, your softwares, your news reading, your Bloomberg portal or whatsoever, you realize that the currency will go down, right? So how you can speculate? You enter into a put option contract as a buyer of the put. After 30 days, you will be enter into a contract of put option to sell the currency who is depreciating at a specific price, so that at the end of the period, you buy from the market at lowest price and sell it at higher prices. Simple. Individuals may speculate with currency put options based on their expectations of the future movement in particular currency. Speculators can attempt to profit from selling currency put options. The seller of such options is obligated to purchase the specific currency at strike price from the owner who exercises the put option. Simple. One side is called seller of the put, other side is called, one side is called buyer of the put, the other side is called seller of the put, right? So seller of the put has the obligation to buy from buyer of the put, right? Simple definition, that's it. If you don't understand, then just draw. If you don't understand what's going on, then just draw. This is buyer of put. This is seller of put. Right? So what is put? Right to sell. So it means buyer of put is called seller of currency. And seller of put is called buyer of currency. Right? So this is a lot of, because buyer of put is seller of currency. So that's why it looks opposite, but it is the same. Okay. So the net profit from speculation is based on exercise price versus the purchase price, premium paid, and all the stuff. Similarly, how you can find out the profit? Sale price minus all the cost. Sale price minus buying price minus one more cost, which is premium. Simple. So we can also denote the call option and the put option through graph. One side is purchase of call option, other side is sale of call option. So purchase of call option, so their maximum loss is the premium. That's it. This is their maximum loss. They pay premium to enter into a call option. What is their profit? So after covering their cost, which is premium plus the exercise price, after covering their cost, if the market goes up, their profit is going to be unlimited. That's why it is going up. What about the seller of the call option? His maximum profit is he will be receiving the premium. That's it. That is his maximum profit. And his loss can be minimum zero. His loss can be zero with the exercise price, and then if the price goes up, he will purchase from you, so his loss going to be increased. So basically it's win or lose option. If buyer of the call wins, so that win is the loss of seller of the call. Simple.